Hello there and welcome back to Dukascopy TV. I'm Monica Gibson and I'm joined in the studio by Bruno Estier. Today we'll be looking at a market overview from a technical perspective. Bruno, thank you very much for coming in once again.
Hello.
Now we're going to talk about the correlation between stocks and bonds today. So if we look, you have some charts for us. What are the charts telling us? What should we expect?
The first chart that we want to look at is the long-term correlation between interest rates and stock market. In school, at university, we learn that when rising interest rates are bad for stocks because the cost of capital is higher. However, recently, since 2000, we are in a period of where people don't know if we are in an inflationary or deflationary period. At least interest rates are moving lower. And basically, what happens every time that interest rates are moving lower, it reflects more the fact that the growth of the global economy is going to slow down, then it is therefore a bad thing for stocks. And when interest rates are moving lower, stocks are also moving lower. And when interest rates are moving higher, it means growth is coming back and stocks are moving back up. And that's what we see here between the different period. For example, in 2008 and 2009, in 2008, when interest rates were moving down from 4 to 2%, at the same time that was the big financial crisis, S&P was moving from 1400 down to 666, as we know. And when it rebounded, the S&P rebounded, also the interest rate rebounded. This correlation is mostly on the positive side between yield and S&P. However, it's not always the case, and we're going to see where interest rates are heading now. The next chart is a very long-term quarterly chart since 1989. Especially interesting for us is the period since 2007 when interest rates were at 5% and they move all the way down to 1.4% in the mid-2012. Now what we have in theory for technicians, it's still a downtrend. We are making lower highs and lower lows. The momentum has been very oversold. It has displayed a rebound recently, and this rebound is expected to remain below the long-term downtrend line, which currently goes through 275, 3%, depending how much time we will go forwards. And probably what we expect is these interest rates to remain between 2 and 270%. When we move to the next shorter term chart, which is a monthly chart, we notice that really this so-called downtrend that we had on the long-term chart is here contradicted by a short-term up move of higher highs and higher lows. We remember, first of all, the interest rate move last year up to 2%, then they tried to go back to 160 around the first quarter, and then suddenly in the last 2 months there was a big move which has been now explained, if you wish, in retrospect by the fact that we know that the Federal Reserve is not going to buy bonds forever. However, now we have already moved to some lofty levels, 2.66, which represent the upper two descending trend lines. So if you wish, it's going to be a place where people are going to say it's good value to buy bonds again. And also, we might see, therefore, with the momentum which is a bit too high, a possibility to go sideways, but remaining below 3% for example, at least for 12 to 15 months. On the next chart, we see what just happened yesterday. This is a daily chart, and we have this fantastic acceleration where everybody was very worried, had time to reflect over the weekend what to do with the bond funds, and finally the last orders to sell bonds funds have been reflected with a spike up into an island reversal, if you wish, which is just a price which opened above the previous price, but probably is going to be left alone in the air, like striking a bubble, and you will see prices coming, or yield in that case, coming down below 250 in the coming days and staying between 240 and 250 for a little while. That's going to tell you something about the S&P probably.
How would that be in the shorter term, do you think, with the S&P?
Well, we need to look at the correlation between, on the next chart, between the S&P and the yields. This is now not a long-term correlation. This is a very short-term correlation on 20 days. And as we see on the top, again, we have the interest rates on a zoom only since 2012. On the middle panel, we have the S&P, and we have noticed that recently the S&P has moved from 1680 to 1580. And on the lower side again, we have this positive correlation between interest rates and S&P, which used in the red balloon down there to be positive, but has changed recently. Indeed, recently, things are a bit complicated. Just before we switch, we noticed that now interest rates are moving strongly up, but the S&P is not moving up anymore. We see the S&P moving down. So is it going to change or not? We're going to look at the next chart. We remember that on this next chart, we had a view about the equity side. We had said that on the second half of 2013, there will be basically a cyclical bear market. The question is, is that because of interest rates rising so much? We are not too sure about that. Okay, we'll think, as we said before, that interest rates will remain probably between 2.70 and 2%. But the question now is, as the stock market has started to make a top, how fast down could it go? Going in a straight line, probably as it is shown here, is too simple. What we wanted to stress on that chart is the fact that it could last for 15 months. And if we move to the next chart, which is a bit shorter, simpler view, because we look only at weekly close, we could envision that after a first decline in 2013, there will be a rebound in 2014 and a second decline there. However, if we go even in a shorter time frame on the next chart, we'll see that things are not going to go in a straight line as mentioned before. Probably short term now we're coming at a support zone around 1555 and could rebound. We could rebound, we don't know how far up we could rebound. That will depend a lot, as Mr. Bernanke is saying, on the data, on the economic data and the expectation of the different market participants. Which participant? On one hand, you have the bond managers, which consider 270 or 266 to be a good levels to buy bonds again and hope it will move back to 2%. On the other hand, you might have the investors, which says, oh, look, we have a second chance to enter this bull market, and at 1550 on the S&P, it is much cheaper than 1680. So let's buy back. Who will be right at the end will depend probably of other external effect that we don't know yet, even though from a technical viewpoint we have a bias and we believe it will be time during the summer to sell at least a second time, because then we expect much lower price in the fall.
The fall before the fall.
That's right.
But do you think the 2% mark could be a psychological level then moving forward?
On the interest rates, probably because we had heard that Mr. Bernanke has said he will stop buying bonds forever, probably 2% is going to be a psychological level where interest rates will not move below that.
Very interesting. Well, again, time will tell, but we'll hopefully thank you once again for the update, Bruno. It's been a pleasure talking it through with you.
Thank you. Well,
that's all from Bruno and myself for the moment. Please do click back to Dukascopy TV for all our hourly updates. Goodbye for now.